Okay. Good afternoon and welcome again to our Zoom and Facebook webinar viewers, and thank you for joining Bellboy's live webinar on Audited Financials for Community Schemes. My name is Chantal van Heerden and I'm a Managing Director of Bellboy, and I'm joined today by my fellow director Shannon Moore-Barnes, as well as Jason Wallace, Bellboy's Operational and Financial Manager. And we are also joined today by our presenter, Hayden Duprier, who is the Director of HDP Incorporated, Registered Accountants and Auditors. Bellboy has been the leader in community scheme property management since 1996. And I invite you to visit our website on www.bellboy.co.za and follow us on Facebook and Twitter. In addition to community scheme property management, Bellboy also offers accounting services for small to medium-sized businesses, as well as staff payroll services. We also offer property rentals and sales services. Today's webinar is the second of our 3 live webinars hosted by Bellboy, wherein we unpack financial documentation provided to our governing body members. Part 1, Understanding Your Monthly Management Accounts, was well received, and should you have missed this webinar, you can view it on Bellboy's Facebook page. We trust that these webinars will assist our governing body members to better understand the financial documentation that are essential to the effective financial management of your community scheme. Now, it gives me great pleasure to formally introduce our presenter, Hayden Duprier, Director of HDP Incorporated, Registered Accountants and Auditors, a firm based in Port Elizabeth. After winning the 100-meter sprint in junior school, Hayden went on to complete his BCom degree at the University of Port Elizabeth, while serving articles at Ernst & Young. He went on to complete his honours degree and board exams whilst working for financial accountant as a financial accountant for a multinational company. Hayden started his audit practice in 1996. This practice is largely audit focused and specializes in community scheme audits, and he has a large client base in Port Elizabeth and surrounding areas. Then with regard to some cyber housekeeping before we get started. If you have any questions during the presentation, please type your question into the question box in the Zoom control panel. I will put as many questions as time permits to Hayden at the end of the presentation. Any questions not answered during this webinar will be responded to following the webinar. Now, without any further ado, Hayden, it's over to you.
Hi attendees. Thanks, Chantal, and thanks for mentioning the highlight of my athletic career. I'm going to switch to my notes. Okay. All right. Okay. So as Chantal mentioned, the focus of the presentation is largely on financial statements or the annual financial statements with emphasis on the roles that the various parties play. Before commencing my presentation, I'd like to clarify some terms and abbreviations which will appear throughout. The first is STSMA, which refers to the Sectional Title Schemes Managing Act of 2011. The regulations, which refer to the Sectional Title Schemes Management Regulations. MA is an abbreviation for Managing Agent. AFS, Annual Financial Statements. PPE, Property, Plant and Equipment. And SAICA, being the South African Institute of Chartered Accountants. Responsibilities of the various parties. As the main focus of this presentation is on the annual financial statements and the roles played by the various parties in achieving fair presentation of the annual financial statements, I'm not going to delve too deeply into non-financial requirements of the STMSA. However, I will make an exception with regards to the trustees, as I believe it important for them to fully understand the implications of their position. With regards to the trustees' responsibilities, the role of the trustee is similar to that of a company director, but it can be more onerous in some respects. Many small companies have sole directors and are owner managed. As from 2012, these companies often do not require statutory audits or even an independent review. Sectional title schemes or body corporates, however, are subject to a full audit. Even though most schemes utilize the services of managing agents who in turn maintain the scheme's funds, it is ultimately the trustees who are responsible for maintaining these funds. The trustees are thus in control of the funds of the various owners who have elected them. Section 8 and the subsections of Section 8 of the Sectional Title Schemes Management Act deal with the responsibilities of the trustees. Some of these are Section 8.1. Each trustee must have a fiduciary relationship to the body corporate. A fiduciary duty is a legal obligation of the highest degree for one party to act in the best interests of another party. Section 8.2a. Trustees must exercise their powers in the interest and to the benefit of the body corporate. Section 8.2b, subsection 2. A trustee should not receive any personal economic benefit, direct or indirect, from the body corporate. I'd like to expand on this subsection, as it often happens that a body corporate may have an owner or trustee who owns a business that can provide certain services, typically of a maintenance nature, to the body corporate. The trustee rendering such services may present a quote to the other trustees, but must recuse themselves from the decision-making process. Even if the quotation process is totally transparent, I would discourage trustees being asked to provide these services. However, the SMA does not prohibit it. If I may digress slightly from the notes and give a practical example of why I discourage this. There were a few years ago, I was conducting an audit and I was examining the quotations file, and I found that the policy of the body corporate in question was that 3 quotes would be obtained for any particular service of a large nature. All 3 quotes were in place, and one of the 3 quotes, which turned out to be the lowest quote, was actually from one of the trustees, or rather his business. And then I noticed that the dates on the first 2 quotes by third parties were 2 weeks before the one submitted by the trustee. The implication of this is that he obtained these quotes and then obviously provided a low quote. Now, I'm not in any way suggesting malfeasance, but this is the type of thing that can be open. And of course, one of the most difficult things to detect from an audit perspective is that of collusion. So I stress once again that while the Act certainly allows for trustees to provide these services, I would personally encourage or discourage that practice. Section 8.3, a trustee who breaches their duty is liable to the body corporate for any financial loss suffered by their actions. In respect of annual financial statements, the trustees are responsible for the following: maintaining adequate accounting records. Now, the regulations define accounting records as the recording of all items of income and expenditure and of assets and liabilities. It's important to remember that financial statements are prepared on the accrual rather than cash basis, and that transactions should be recorded in the correct accounting period. As an example, should the body corporate pay a deposit towards a large repair expense and the balance remains unpaid at financial year end, then that balance needs to be raised as an expense and as an accrual. It's therefore important that all invoices relating to a financial year end are provided to the managing agent, who are responsible for recording of all transactions. In a similar vein, all invoices relating to petty cash expenditure should also be provided timeously to the managing agent. If not, then the preparer of the annual financial statements will receive a ledger account that only shows reimbursements, and this account will thus be overstated. I'm talking, of course, of the petty cash account. Ideally, as auditors, we would like to see a year-end reconciliation signed by the trustee with a balance that matches the general ledger account for petty cash. A further responsibility is the preparation or preparing the annual financial statements. Obviously, this means having the annual financial statements prepared by a third party, which must then be audited. It's not saying that the trustees actually have to compile the financial statements for presentation to the auditors. And then they are responsible for implementing and maintaining a system of internal financial controls. Typical examples of what auditors look for when conducting the audit are the quotation process, authorization limits in respect of expenditure, and signed authorizations of payments. It is highly recommended that the monthly management packs that are sent by the managing agents be scrutinized and signed off by 2 trustees. And finally, there's also the obligation to prepare a 10-year maintenance plan. This is a requirement of both the Sectional Title Schemes Management Act and the regulations. The auditor's responsibilities. Our responsibility, in a nutshell, is to obtain reasonable assurance that the financial statements are free of material misstatement. Misstatements are material if they can reasonably be expected to influence decisions made by users of the financial statements. You will note the term users of the financial statements. These users would include prospective buyers into the scheme, banks providing finance to prospective buyers, finance institutions should the scheme require financing, etc. And finally, and hopefully this is not something that happens too often, we have an obligation to report material irregularities. If there are material irregularities, these need to be reported to our audit board. Before doing so, our intention thereof needs to be sent to the trustees for their comment. Then we get on to the managing agent's responsibilities. Unless they are acting as executive managing agents do not have any responsibilities in terms of the ST-SMA. They are tasked with assisting the trustees in carrying out their duties as defined. Typical services provided by managing agents include collection of levies, arranging for issuing of clearance certificates, paying all expenses, preparing monthly income statements, assisting with the preparation of annual budgets and the investment of surplus funds, and attending trustee and annual meetings. Now, we go on to the audit report. Before progressing to the financial statements, I'd like to deal with the section of the audit report that has caused a lot of confusion, namely the one that's headed Management of the Body Corporate's Financial Affairs and Funds in terms of Rules 26(5)(c)(3) and 4. This paragraph states the following. In terms of relevant international standards applicable to audit, review, and other assurance engagements, we were unable to conduct an engagement relating to whether the books of account of the body corporate have been kept and its funds managed so as to provide a reasonable level of protection against theft or fraud, and whether the financial affairs of the body corporate appeared to be effectively managed as required by Rules 25(c)(3) and 4. We have not performed any audit, review, or other engagement in relation to these matters, and accordingly, we do not express any assurance, opinion, or conclusion thereon. Some frequently asked questions are, does this paragraph mean that the audit report is qualified? No. If an audit report is qualified, it will state that in the heading of the report, as well as have paragraphs explaining the reason for the qualification. Does this paragraph mean that no audit has been conducted? No, a full audit was conducted on the annual financial statements, but no audit was conducted pertaining to those sections of the ST-SMA. And finally, does this paragraph mean that the managing agent has not fulfilled their obligations? No, because all responsibilities for internal controls are those of the trustees. Slightly off the topic in terms of the frequently asked questions is just to also elaborate on the term unqualified report, because some people have actually misinterpreted the term unqualified report to mean that the report was prepared by an unqualified person. This is not the case and actually refers to it being a clean audit report, i.e. no qualifications were made in terms of the disclosure. Returning to this paragraph, below is a direct extract from SAICA's policy note on this paragraph. SAICA is the supreme accounting institution in South Africa, and the audit report that we use was prepared by them and distributed to its members. I'll read as follows. The registered auditor can only accept the engagement if the preconditions for an audit or an assurance engagement are met. Two of these preconditions are that the underlying subject matter is appropriate. In other words, it is unidentifiable and capable of consistent measurement or evaluation against applicable criteria, such that the resulting subject matter information can be subjected to procedures for obtaining sufficient appropriate evidence to support that auditor's opinion or conclusion, and the criteria that the auditor expects to be applied in the preparation of the subject matter information exhibit all the characteristics of the suitable criteria. The assurance engagements, or part of an insurance engagement, as contemplated in Rules 26(5)(c)(3) and 4, would not meet the above preconditions of an assurance engagement, and therefore the registered auditor will have to decline the engagement. The management of funds in a manner so as to provide a reasonable level of protection against fraud and theft, and the effective management of financial affairs of an entity are not generally identifiable and would not be able to be evaluated or measured against identified criteria, so as to provide a basis for concluding on these matters. This means that there is no consistent way that one could measure a reasonable level of protection against fraud or theft, and no consistent way to measure whether financial affairs appear to be effectively managed. Since the subject matters are not appropriate and there are no suitable criteria for the evaluation or measurement, it is not possible to express the auditor opinions as contemplated in Rule 26(5)(c)(3) and 4. Now, the explanation that I read is fairly technical, so perhaps I'll provide a couple of examples. Let's assume that the body corporate needs to have major renovations. The trustees decide to obtain 3 quotations. Immediately there's a problem. Are 3 quotes enough? How do the trustees decide on which contractors to approach? Having obtained 3 quotes, the trustees decide to implement the internal policy, which is always to use the lowest quote. Should this be the only criterion? What happens if the contractor who supplies the lowest quote ends up doing a poor job and the body corporate has to pay substantially more money to correct his workmanship? Have the trustees not then made a poor financial decision? Alternatively, the trustees may decide to use a highly reputable contractor who charges the body corporate substantially more than a cheaper and lesser known contractor who may actually have good workmanship. Have the trustees made the best financial decision for the body corporate? A further example would be the investment of surplus funds in a high interest-bearing account. Should this be done on a monthly basis? If so, has the body corporate not experienced a loss of an additional month's interest? So I think I'm hoping that these examples will illustrate why it's not really possible for us as auditors to render the opinion that the section required, and why SAICA has advised us to include that paragraph in the financial statements. One must also, if one goes back to earlier on, where I mentioned materiality. What is materiality? Apart from the fact that we've mentioned a misstatement that could alter the interpretation by users, there is actually a measurable criteria. Typically, it's 1% of turnover. In other words, in the case of a body corporate, it would be 1% of the levies collected for the year. Now, if you have a small body corporate where maybe the levies for the year are only say 100,000 Rand, that means the materiality is 1,000 Rand. So in order to satisfy those conditions per that paragraph, we literally would be having to check every single decision made on every expense in greater than 1,000 Rand. The amount of time spent on the audit would be huge, and obviously would result in costs, which would be totally outside what the body corporates would be prepared to pay. But more than that, it's actually, from an audit perspective, it's not possible to satisfy those sections. When the Sectional Title Schemes Management Act was drawn up, none of the accounting bodies were actually consulted, and hence we have 1 or 2 of these types of issues. But this has been the main one, especially when the financial statements started changing, which was right about 2018, that resulted in the most queries from trustees and owners. So having discussed the various responsibilities, I'd like to get on to looking at the actual financial statements. And if you bear with me, I'd like to go through the various components first before taking a look at an actual set of financials. So starting off with the income statement. The income statement is divided essentially into 3 sections. We have our revenue section. Your typical line items in the revenue section would be levies, which would comprise so-called normal levies as well as reserve fund levies. Then we would have special levies, these being levies which are raised to cover unexpected expenditure. Now, if you recall, we mentioned the trustees' obligation to have a 10-year maintenance plan in place. And one of the reasons for the implementation of a 10-year maintenance plan is to avoid special levies having to be raised. So typically going forward, one shouldn't really see this line item, but it still exists. Another typical line item in the revenue is that of recoveries. The most common type being the recoveries of municipal charges. There are some schemes who want CSOS levies that are collected and paid to be reflected in the income statement with any amounts owing in respect of those levies to be reflected as an accrual. Now, strictly speaking, there should not be any income statement disclosure, as the body corporate is merely acting as an agent for the fund, much like businesses collect VAT on behalf of SARS. But the trustees do have some leeway with regards to departure from conventional accounting standards. If there are such departures, then these are normally disclosed as an emphasis of matter in the audit report, and once again, do not result in any form of qualification. In fact, SAICA introduced specific wording in the audit report to allow for this. And finally, we would have interest received, and we normally show a separate disclosure of the interest with regards to interest that's received on investments and bank accounts and interest that's charged on arrear levies. In the expense section, additional disclosure is required for certain expenditure items, for example, insurance. When we have a look at the financial statements, we will note certain things that have to get disclosed in respect of insurance, and then we normally provide a breakdown of municipal charges and repairs and maintenance. And then the third section is what we refer to as below the line items. These would include taxation as well as transfers to the reserve fund. The income statement example which I've provided does not have taxation, but if I may, I'd like to discuss this briefly. Body corporates are taxed on all income other than levy income. Examples of taxable income would thus be interest received and rental income. Sometimes you will find in a scheme that maybe that scheme owns a unit in the complex which they rent out. Sometimes they rent space to places like Cell C or Vodacom or signage, whatever. These are all subject to income tax. However, the Income Tax Act does provide for a 50,000 Rand exemption. So what we do is the amount, we then take those income amounts, deduct the 50,000 Rand, and that amount in excess of 50,000 Rand can then have certain administration expenses, such as bank charges, accounting fees, printing and stationery written off against it. It works by way of formula. And then the final taxable amount is subject to income tax at the corporate rate, which is presently 28%. Moving on to the statement of financial position. Let's start with assets. We have non-current assets. Typically, non-current assets would comprise property, plant, and equipment. But this is also not a typical item in most body corporate financial statements because these tend to be expensed. It should also be borne in mind that SARS allows all fixed assets under 7,000 Rand to be expensed. Should the trustees require disclosure of property, plant, and equipment in the financial statements, then they also need to decide upon a depreciation rate. Depreciation is an income statement expense, and it is highly recommended that even if PPE is expensed in the year of purchase, in other words, it doesn't appear on the balance sheet or the statement of financial position, that a fixed asset register be maintained for all fixed assets owned by the body corporate. As I said, it's not typical for this type of disclosure, but it's perfectly acceptable for the trustees to decide on declaring or disclosing financial PPE in the balance sheet. Investments are also deemed to be non-current assets. These can be unit trusts or other such investments. Once again, these aren't typical items in the financial statements, but they do exist. There's a lot of examples where, for example, a larger scheme may have a full-time staff member and they'll take out a policy on their behalf, and this needs to be disclosed under non-current assets. Current assets, these would typically be levies in arrear. As you will see when we get to the example, that all arrear levies need to be noted and an age analysis needs to be disclosed of amounts owing to the body corporate at year end. Normally there's a municipal deposit, which is a current asset owed to the body corporate by the municipality. And finally, we have cash and cash equivalents. These are monies held in trust by the managing agent, bank accounts in the name of the body corporate, and of course, as mentioned earlier, petty cash. These are also disclosed separately by way of note. Equity and liabilities. Equity refers, there are normally two components of equity. The first is the administrative fund. In the past, this would be called retained income or the general fund, but the Act does require to be referred to as the administrative fund. And this comprises accumulated surpluses built up over the years. In other words, one could also call it a retained profit, but I prefer the term surplus. And it's also disclosed separately in the statement of equity. We then have the reserve fund, in the past often referred to as a maintenance fund, and these are accumulated surpluses that are to be utilized for reserve fund expenditure, in other words, major repair items, etc. Ideally, the fund should have a matching bank account. So if the reserve fund has a balance of 100,000 Rand, we expect to actually see a separate bank account with 100,000 Rand in it. The surpluses that accumulate arise from the collection of maintenance levies, interest received that is earned on the investment account that's specifically open for the reserve fund, less, of course, any reserve fund expenditure such as bank charges, and then, of course, monies that are transferred out in respect of major capital items. I think those of you who've been involved as trustees for a while will probably remember 2018. This is when the changes were coming into existence, and typically in the first year there were large transfers between the administrative and reserve funds, which was because ideally the administrative fund should not be sitting with a huge surplus, and there should be funds that should be available for future expenditure. Your non-current liabilities, these would be long-term loans and are disclosed by way of note. Typical of this would be financing received for major expenditure items. There are certain agents who provide financing, and then for body corporates that have experienced troubles with collection, there's a company, for example, called Propel that provides financing, etc. Current liabilities. These would typically be levies paid in advance. Once again, this is disclosed by way of note. And creditors. Creditors normally consist of the year-end mutable account, the audit-free provision, insurance claims control, repairs invoices, the balance of repairs where a deposit has been paid, as I mentioned earlier, and CSOS levies payable. All of this is disclosed by way of note. These are supposed to be current. So just as we note the aging of levies in arrear, if, for example, there is a repair that has not been paid, that is not current, in other words, 30 days, then this should also be disclosed in the note to the trade creditors or creditors. And then getting back to the Propel financing as an example, they're of course not the only institution to provide such financing. What often happens is that they take control of the collection of levies and sometimes pay the body corporate those, whatever the amount was in arrears at the date of them taking over, they actually forward to the body corporate for cash flow purposes. So there is a contingent liability, because if that contract ever ends, those funds need to be reimbursed. So at year end, we should be receiving a list of such amounts to be disclosed as a contingent liability. But with my experience with Bellboy, I think there are very few of those, if any, that I deal with. But that is also something that can appear if relevant. Then we get to the cash flow statement, which I believe the cash flow statement is particularly important because it answers the question, where has the money been spent? It is effectively a reconciliation of the bank accounts, reflecting movement for the year on cash and bank balances. So the cash flow statement starts with the net surplus for the year. Non-operating income and expenditure is then removed to reflect an operating surplus or deficit. Non-operating income and expenditure is typically an item like depreciation and interest received and paid. The current assets and liabilities, cash movements are then disclosed. Now, let's assume, as an example, that we will see that levies in arrear have increased during the year. This is detrimental to cash flow as it indicates that not all debtors are being collected. In other words, there's money that could have been available to the body corporate that's being tied up in money to be collected. So so this is a negative in terms of the cash flow statement. And while an increase in current liabilities may be seen from a business perspective as an indication that the entity has been able to meet its obligations, which of course is a good sign, it is a negative from a cash flow perspective. Hence a decrease being a negative amount and an increase being positive. This is something that, once again, people often ask, why is it being shown as a negative or positive? It has to be seen in the context of the cash flow, and cash flow only. And then also disclosure is required for the purchase of PPE, because that sort of expenditure is a negative cash flow item. Money has been spent on the acquisition of such assets. So what I'd like to do, if you just bear with me for 1 second, I just need to go on to the financial statements. And let's do that. Right, okay, we're Back. Okay, so I'm going to start, before we get onto the financials themselves, just to get back to certain extracts of the report in terms of, as we mentioned, responsibilities. I'd like to look at what you would find in the Body Corporate's Trustees Responsibility Report, just to amplify what was said earlier. The trustees are required to maintain adequate accounting records and are responsible for the content and integrity of the annual financial statements and related financial information included in this report. It is their responsibility to ensure that the annual financial statements fairly present the state of affairs of the body corporate as at the end of the financial year and the result of its operations for the year then ended in conformity with the basis of accounting as set out in Note 1 of the financial statements. In other words, I just need to amplify that the trustees are ultimately responsible for the financial statements. Us as external auditors need to check on that and confirm that the financial statements are correct, but it is ultimately the trustees' responsibilities. Going further on into the report, the trustees acknowledge that they are ultimately responsible for the system of internal financial control established by the body corporate and place considerable importance on maintaining a strong control environment. The system of internal financial control is aimed at reducing the risk of error or loss in a cost-effective manner and includes the proper delegation of responsibilities within a clearly defined framework, effective accounting procedures, and adequate segregation of duties. These controls are monitored throughout the body corporate, and all employees are required to maintain the highest ethical standards in ensuring the body corporate's business is conducted in a manner that in all reasonable circumstances is above reproach. While operating risk cannot be fully eliminated, the body corporate endeavours to maintain it by ensuring that appropriate infrastructure, control system, and ethical behaviour are applied and managed within predetermined procedures and constraints. In other words, once again, while the managing agent is responsible for carrying or assisting the trustees in carrying out these their duties, including maintaining good internal financial controls, it is the trustees' responsibility to ultimately ensure that these are in place. So if we can then progress to the financial statements of the body corporate of ex-villas. So at the top, for those who may not have accounting knowledge, the format of the balance sheet, or as it's correctly referred to, the statement of financial position, has changed. This is the correct format, which starts with assets. So as previously discussed, we have non-current assets, in this case comprising property, plant and equipment. This has to be noted. So if I go to the note, we see then it was garden equipment that during the course of the year was purchased and it was depreciated, and the net book value, in other words the cost less the accumulated depreciation, is disclosed. Depreciation is actually very important because obviously all items of equipment, whether it be a motor vehicle, a lawnmower, etc., has a useful life, and all financial statements have to accurately disclose the assets and liabilities of that particular scheme. So, for example, if we can't have a policy whereby depreciation is not reflected, otherwise equipment that is obviously has run the course of its useful life will still be shown as the original cost. So depreciation has to be decided upon. There are no tax implications of depreciation because, as we've previously discussed or mentioned, the body corporate is taxed purely on income other than levy income. So depreciation expense is of no relevance, but it has to be accurate. So in other words, if you purchase an item of equipment that you feel will last 10 years, then the depreciation rate has to be 10%. Returning to the balance sheet, we then have our levies receivable. And there, as discussed, these need to be aged separately, being current 30 days, 60 days, 90 days. Obviously, hopefully we don't get into 120 days and over, but that is the type of disclosure that's required. With regards to municipal bonds, as well, that's there's no real reason for a note for that one. And then cash and cash equivalents. In this particular case, it's made up of a current account and an investment account. Obviously, there can also be petty cash, but those are typically what would be disclosed as cash and cash equivalents. The equity and liability section. So the capital and reserves, which is the equity, comprises the administrative fund, which is the accumulated surplus, as well as the reserve fund. So if I may start with the administrative fund, as mentioned, there is also separate disclosure in the statement of changes in equity, which the statement of changes in equity effectively covers the last 2 years, and it's a summary of what has happened through the 2 reserve accounts. So in the example that you see on screen, at one stage, this particular body corporate had a negative admin fund. During the course of the last financial year, there was a substantial surplus. It transferred some money to the reserve fund and ended up with a small surplus. And in the current year, once again, there was a transfer to the reserve fund, and there was a surplus for the year, and it's resulted in the following being accumulated surpluses, or as I said, some people would think of it as a retained income. And there it is in the balance sheet. The reserve fund is also disclosed in the statement of equity, but I normally encourage that we have a note for that as well. So the reserve fund note would have had an opening balance. So let's look at the comparative figure, an opening balance. There would have been a transfer from the admin fund. We normally split it between admin fund and if there was interest, and then utilization. This, in other words, is if certain repair items were actually taken out of the reserve fund. As I mentioned earlier, in the ideal world, the reserve fund balance should have a matching bank account. So that's what we're seeing there. From an audit perspective, as I said, this is ideally what we should have. I don't have a major problem if the investment account exceeds the reserve fund, but I don't really like seeing the reserve fund being greater than the investment account, but obviously there has to be a reasonable amount of time given to the body corporate to get to that position. But this is the ideal world scenario, that the reserve fund has a matching bank account. Then we get this particular example, like I said, doesn't have long-term liabilities in. If we did, say for example, there was a loan to for major renovations, then there would be a separate loan, a separate note for that stating who the body corporate borrowed money from and on what terms, etc. Then current liabilities. Let's look at the note for accounts payable. In this particular case, we have the municipal account balance owing at year end, accounting fee provision, audit fee provision. In this particular case, Bellboy was owed money probably for printing and stationery. The CSOS levies, which, like I said, this is money like VAT that's collected on behalf of another institution. As far as I recall, the obligation is to submit CSOS levies every 3 months, or pay it over every 3 months. So there will be some, depending on the year end of the body corporate, there can be a case where this will be zero. And then in this particular case, there's also some repairs and maintenance that was owing. And then we have our prepaid levies, which is simply levies that owners have paid in advance. So that is the statement of financial position. Then we get on to the statement of income and expenditure. As I said, these are sort of your typical line items. This particular body corporate didn't have recoveries of any sorts. And as I said, I don't personally believe in showing the recoveries of CSOS levies, but if the trustees want that, that's not a problem, because there is a certain amount of departure from financial reporting that is allowed by body corporate. So here we have levies received, the real levy interest and interest received. We go down to your expenditure, sort of your typical expenditure items. There we have our depreciation, as mentioned, in this particular case. Insurance, this is noted and just simply states who the insurer is, what sort of cover they have, and what the renewal date of the policy is. Management fees, municipal charges, as also mentioned, this is normally, I do prefer to note this separately, splitting into the various components of those charges. Repairs and maintenance is also noted separately, and there's an example in this particular case. There's reserve fund expenditure, which is then transferred to the reserve fund, hence this item below the line. So the actual expenditure that came out of the administrative fund was 50,000 Rand. This body corporate didn't have any tax, but here's a below the line item being transferred to the reserve fund, as well as and a transfer to the reserve fund of interest that was earned on the investment. We've already looked at the statement of change in equity. And finally, let's look at this cash flow statement. So the cash flow statement starts with a disclosure of the surplus or deficit for the year. It's important to note, if one refers back to the income statement, that this surplus is before transfers to the reserve fund, because the reason for that is as follows. When we are doing the cash or looking at the cash flow statement, the amount that we're disclosing in terms of cash and cash equivalents pertains to admin and reserve funds. So these items here, which are transfers between reserves, even though a physical transfer may have taken place, it is between the bank accounts belonging to that entity. So it's it wouldn't be appropriate to have this as part of the cash flow. We would have to look at the surplus before such transfers are made. So that is the opening position of the cash flow statement. Then we make adjustments for items that are not relating to operating activities. For example, depreciation. Depreciation, of course, is a non-cash flow item. This is not money that came out of the bank. This is raised by way of journal entry. Interest received. Interest is not part of the operations of the body corporate. Levy income, for example, is. So this is excluded, as would be interest paid if there were, for example, interest paid on arrear mutual accounts. And then the reserve fund utilization is disclosed as a separate item because this was a cash expense, which, if we go back to the notes, we had removed at that level. So any reserve fund utilization has to be disclosed in the cash flow statement. So then we get our operating surplus or deficit before our working capital changes. Working capital refers to current assets and liabilities. So in essence, it's a comparison between the 2 years. So if we go back to the balance sheet, we have the mutual deposit is part of that, but there was no movement in that. So if we take a look at levies receivable, they were 6,800 Rand the previous year. This current year, they went up to 11,300. As I mentioned, this is actually a negative from a cash flow perspective because there's now more money being tied up in debt to be collected. This particular movement was 4.5. And as I said, because it has a negative impact on the cash flow statement, it gets disclosed as a negative in the cash flow statement. Then we get to the trade and other payables. We go down to the current liability section. This is basically the movement between these two sets of accounts. So if we take a look last year, there was a total of 9,800 Rand owing to various creditors, including owners, for advance payments. This year it's gone up to 14,150. So we've actually, if it was a business, we would say we've utilized our creditors' money to improve our cash flow. So that increase in trade and other trade and other payables is therefore a positive cash flow and is therefore shown as a positive. We then have cash generated by operations, which is made up of this subtotal and that subtotal to give us the amount. This is positive. It means that cash has actually been generated by the body corporate, implying as we show that there is a surplus, etc. We then show our cash flows from investing activities. Investing activities will obviously be investing in a bank account. So we show our interest there. As you can see at the top, we had shown it as a negative because we had wanted to remove it from the operating activity. So really it's just the two amounts of contrary out. And then we have acquisitions of fixed assets, which if we go back to our notes, is not the net book value of those assets of 11,200. It is the amount that was actually paid. Because remember, depreciation is a non-cash flow item. So that 12,200 Rand that was paid for this garden equipment is the actual cash flow item that needs to be disclosed. And as I mentioned, because it's an outflow of cash, it gets shown as a negative. In this particular case, finance activities, we haven't raised any loans. There's no interest paid, so there's no entry there. So then we get to our final total. And it basically says that during the course of this year, our cash flow improved by 15,000 Rand. And this cash flow has really, up to that point, has really told the story of how our cash flow has improved. We then show the opening balance, which if I can just go to last year's balance sheet, there's an amount of 105. and we've increased it by 15, so we should have 120,000 rand sitting in our bank account, and the cash and cash equivalents is stated at 120. Let's just go back to the notes, if I may. So just going through them again, in this particular case, we have to show property, plant and equipment separately. We show it less depreciation. Our levies, we show an aging of levies. Cash and cash equivalents, we could also have petty cash as an example. Our reserve fund, this is a repeat of what is being disclosed in the statement of equity. Accounts payable, these are current liabilities as at the financial year end. Prepaid levies, levies received in advance. Details of the insurance. Just as, by the way, some complexes, there can be complexes who for some reason do not have insurance in place. This actually then would also form part of the audit report. It would not result in a qualification, but it would certainly result in an emphasis of matter if the body corporate does not have adequate insurance in place. We have our municipal charges and our repairs and maintenance showing monies that are transferred. What this should actually have had as well is a breakdown of that 9,000 and 30,000 to actually show what particular items were paid for out of the reserve fund. So that is the end of my presentation, and welcome any questions.
Hayden, thank you very much. Yeah, look, it's good to unpack audited financial statements for the trustees to get a better understanding of it. And similarly, I think it's important for the trustees to understand their role in perusing these audited financial statements before they get sent out to the members of the body corporate with a notice of the AGM. And also on that point, often the draft audited financial statements are sent to the trustees to peruse and sign off before the auditors actually issue the final set. And Hayden, I don't know if you just want to quickly just touch on that, why it is also important for the trustees to actually peruse these audited financial statements, sign them off, send them back before we can actually get the final set to be circulated to the members.
Yes, that's actually a very good point, Chantal. There's actually two issues there. The first is, as I said earlier on, the trustees have a great responsibility in terms of their role and what they need to achieve in terms of financial statements. And I equated that to that of the directors. Now, if I may, when it comes to a company, even one that's not subject to audit, this is governed by the dictates of the Companies Act. And the Companies Act actually does state that before the audited financials can be signed off by the auditor, a draft has to be sent to the directors for their signature. And these can only be distributed to shareholders at the AGM once both parties have signed. So auditors typically do not sign off those financial statements in terms of the Companies Act. And while there's not that particular section in the STSMA, obviously it's a code of good practice. So from our perspective, we do actually require signature by two trustees of the financial statements. We require them to sign the trustees' responsibility report. So it's just, shall we call it housekeeping for all intents and purposes, but it is a requirement. But more importantly, and I think this is what you're alluding to, Chantal, it's extremely important that the trustees understand those financials, because by signing those financial statements, that means they are in agreement with what our findings have been. And because they are ultimately responsible for the integrity of those financial statements, they are also liable if there are any errors, etc. So it's very important that trustees understand that the financial statements are clearly presenting the financial position of the body corporate. And of course, there's also odd things that us as auditors are not necessarily too concerned about. What I mean by that, if I go back to what we were saying about materiality and disclosure, if you actually take a look at the balance sheet as a whole, and I'm sorry if my answer is a bit lengthy for the question that you've raised. If you take a look at the individual components and we look at property, plant, and equipment, every single balance sheet account is being audited, as of various income and expenditure accounts. But if every single balance here has been verified by supporting documentation, third-party evidence, etc., if you can almost say that the balancing figure in a balance sheet is the admin and reserve fund, which is made up of accumulated surpluses and deficits recorded over the years. In other words, the income statement. So if the balance sheet is correct, and that is correct, that implies that the net surplus or deficit for the year that has been recorded is correct and has been over a period of time. However, you may have a situation where there can be a 200 Rand amount that's sitting in printing and stationery that should have been allocated to telephone. Us as auditors are not going to be concerned with that, and I'm sure the users of financial statements are not going to be concerned if something similar. But in terms of for fair presentation and for budgeting purposes, it may be important to the trustees and the owners. Also, with regards to repairs and maintenance, as I said, we separate what is painting, whatever, that may be of importance. So my long answer to your question is that the trustees, because they are responsible for signing off these financial statements and are responsible for the correctness thereof, it's very important they understand what they're reading and that they are in agreement with that.
Hayden, thank you very much for that. We actually only have time for one question, which I'm going to put to you quickly.
Yes.
The question is, if there was a discrepancy in the books of the scheme or the complex, when will it show in the audit report, especially if the matter was brought under the attention of the body corporate and the arbitration, and they, in this case referring to CSOS, found as to dismissing the case? I'm
not quite sure I understand the question. Sorry, Chantal, can you repeat that?
Yeah, so, sorry, Hayden, I was going to quickly go back there. So basically what they're asking is if there's a discrepancy in the, say, the vouchers or the invoices that is submitted to the auditor, does the auditor actually scrutinize all those vouchers against the payments made? And how will that discrepancy, if it's picked up by the auditor, reflect in the set of accounts where a matter, for argument's sake, was referred to CSOS, but CSOS didn't rule, they dismissed the application?
Okay, that's an interesting question. There's actually several components to it. First of all, obviously, this is where the managing agent comes in, because, like I said, there's no responsibility, but certainly they're acting as agents. So we, as auditors, would expect the managing agents to make us aware that there was a case during the year under review. Now, once again, I'm sorry, I tend to go into maybe a little bit too much detail, but also it depends when the arbitration took place. For example, if we are busy conducting the audit of a body corporate with a June year end, and this case went to arbitration during the year, and the findings were only issued in July or August, in other words, after the period, we still need to be made aware of that. The way I would treat it is if the case was dismissed, in other words, the body corporate and obviously the trustees were not found guilty of any malfeasance or error or anything, then it would probably that would not be reflected in the overall report. But if there was, then it would appear as a post-balance sheet event. And there would be a separate recording of that in the financial statements. So we would obviously be very dependent upon the managing agent to make us aware of that. In terms of discrepancies, look, obviously we conduct statistical sampling and sample and invoice sampling. We don't scrutinize every single invoice. Obviously, every single item that is material is looked at, and there are certain audit procedures that are performed on that, including validity, etc., of those invoices. Obviously existence, authorization for payment, etc. So, but not every single one is looked at, and that's why I said if there's a small 300 Rand printing and stationery invoice, we're probably not going to look at that. A lot of the income and expenditure items are covered via statistical sampling. So the discrepancy, though, however, once again, we would probably be relying largely on the managing agent, because one would assume, from what I'm gathering, it's almost as if there was possibly an internal dispute, which would probably be made available to the managing agent. And then we would not be aware of that unless the managing agent confirms. And I know I've actually, strange enough, had examples of this before, where we have audited financials, received invoices, and then a trustee has actually presented duplicate invoices with different details further on. But one must understand, if one looks at the various reports, etc., the auditors can only do so much. As I mentioned earlier, collusion, for example, is always difficult to detect. So we do rely largely on the managing agents and indeed the trustees. I mean, trustees and owners are obviously more than welcome to make that sort of information available to us as auditors. Getting to your specific question, mentioned though that the case was dismissed, and just as I said, it would affect us talking about a post-balance sheet event. We can't, if something has been dismissed, and that means there was obviously some sort of case. So that would imply then that the invoices that were under dispute were in fact correct. However, it would probably be appropriate for us to at least send that out in a letter to the trustees to say we became aware of the situation. There was a finding by the court, but this is what we found. But unless there is specific evidence that there has been an issue, invoices are incorrect, it would not be part of the financial statements. Obviously, if they are incorrect and those are findings, we would qualify the audit report, or if they're not too material, you should emphasis of matter. I hope that answers the question.
Yes, thank you very much, Hayden. Thank you very much. We're going to have to close this webinar now. I just want to, and thank you, Hayden, very much for your time and explaining and unpacking the audited financial statements. We really do appreciate it. Just in closing, to all our viewers, on Thursday, the 3rd of September, will be our final topic on financials, which will be scheme budgets. And that webinar will be presented by Jason Wallace, our operational and financial manager. Again, Hayden, thank you very much for your time. It is really much appreciated. This webinar will also be uploaded to our Facebook page if people want to go back and view it again. Have a good afternoon. Thank you very much. Bye. Thank you.